Assalamu alaikum friends, welcome to SBR revision series for September 2021, and this one is the last revision series video, and we are going to cover the current issues for your SBR exam. And current issue is a topic 100% you're going to get. Okay, so you have to be aware of all the current issues that is taking place. So let's start with the topics that we are going to cover today, starting with the contemporary business environment, accounting policies, material. These are the current issues. Okay, materiality, disclosure of accounting policies, defined benefit plans, that is IS 19, management commentary, sustainability, debt and equity, deferred tax. So these are some current issue. Okay, now let us start with the exam focus. So for your exam, this is a central. Okay, that means it is tested in every exam, current issue. And from your exam kit, these are the questions you can do. Did you buy a Zach as soon and Aspire? And I have completed almost all the questions, so you can go and check. Okay, and if I have not covered any question, you can definitely wait a few more days. I will be covering it for the December session. Okay, and one more thing, that current issue, my lecture is not out on the current issue because I couldn't cover the current issue in the lecture, but definitely for the one who have missed out on that lecture, they can make it out through this video, this revision series for the current issue, because this includes everything. So contemporary business environment, there are two contemporary issues. One is cryptocurrency, the other one is natural disaster. Okay, what is the impact of this? Basically, that's what you need to know. So cryptocurrency, let us first go through cryptocurrencies. Cryptocurrencies are virtual currency. The meaning of cryptocurrencies are, they are virtual currency. You cannot touch them, they are not tangible. They are virtual. Okay, they are online, that provide the holder with various right, but you have the right by having that currency. It is not issued by any central authority, so that means it is outside the government control. Government does not control it. Okay, that's why the accounting treatment for this is very unclear. But cryptocurrency is not the following things. It is not a cash, because you cannot readily exchangeable for goods or services. Please understand the reason also when it's not something, because there has been a question on this. I don't remember the question number, but very recently about cryptocurrency only. Cryptocurrency has to be how it should be treated as an intangible asset versus a financial asset, right? That's the reason you have to know. Second thing, it is not a cash equivalent also, because the risk of value change is very significant for cryptocurrency. And to be a cash equivalent, the definition of cash equivalent means your risk of value cannot change very significantly. If it changes, then it's not a cash equivalent. So cryptocurrency cannot be cash equivalent also. Third, it is not a financial instrument also. Why? You don't have a contractual right to receive cash. That's the reason. Then what is it? It normally falls within the scope of IS 38, intangible asset, because as I told you, you cannot touch it. It's intangible. Okay. So any income or any expenses that arises from the fair value remeasurement, this has to be presented in other comprehensive income rather than in profit and loss. For cryptocurrency, we are talking about. Okay, and you might need to apply the conceptual framework also to develop an appropriate policy for cryptocurrency. So for cryptocurrency, all this much has been talked about. Now we are going to natural disaster. So what do you need to do in conclusion? That cryptocurrencies are treated as intangible asset under IS 38. Okay. Natural disaster is the second type of contemporary business environment. So for natural disaster, this can have impact on many things. Okay. Natural disaster could be like flood. Okay, and it's very common nowadays, floods and all. So this can have impact on your financial reporting consequences, such as your assets are impaired, inventory valuation problem, going concern disclosure, because going concern can be an issue after a flood, provision for restructuring, you might now have to restructure after a flood, and insurance proceed and contingent asset. Okay, you might have to recognize or disclose a contingent asset or recognize in this insurance proceed if you're going to get. So for accounting policies, now let us go to the second type of current issue, that is accounting policies. according to IS 8, because IS 8 only deals with accounting policies, changes in accounting policies, estimates, and error. They say that entity can only change accounting policy under two conditions. Number one, if it is required by the standard, IFRS standard, or changing the accounting policy will be more reliable and relevant information will be given to the user. Then you can change. Otherwise, no. So if this or that. If the change is not required by the IFRS standard, then you have to implement it retrospectively. Retrospectively means go back and change the accounting policy. If it is practical to do, if it's not, then you cannot go back and change. Why? Remember, calculating the prior year impact, that means going back and having calculating that impact. Number one, is costly also, it's time consuming also. That's why this is the reason why most entities they don't want to change accounting policy. They deter this, even though that change is going to affect the user. So because of that, what did the board do? Even though it's good for the user, but they are not doing it. How the board is coming up with a solution for this? They are concerned about the change in policy. So the board is concerned about those changes in policy that arises as a result of agenda decisions that are made by the IFRS interpretation committee. Okay. Usually this agenda decisions, what do? They give the best possible solution on how to apply an accounting policy. Okay. So there has been exposure draft also on that. The board have issued an exposure draft. If you see, it's the very latest year, 2018 Jan, for the accounting policy changes. So if there is any accounting policy from agenda decision, it should be implemented retrospectively. Unless it is impractical to do it retrospectively because maybe you don't have the data in the past, or the cost of working out the effect is more than the benefit of it, benefit to the user. Then also you should not do retrospectively. Now let us go to the materiality, the third current issue. What is materiality? And how does it have an impact? See, it is very important. We know that materiality is very important concept, but users, both the user and the preparer, they need more guidance on this materiality. How much is material? What is material exactly? That's the reason why the board has published a guidance also in the practice statement. These are some different statements from your IFRS and IAS standard. Right, we went through all IFRS and IAS standard, but apart from that, we have something like exposure draft, management commentary, practice statement. Okay, so under practice statement, board has given guidance on materiality. So materiality, the definition of it is that if you omit anything, if you try to conceal anything or misstate a figure, it can affect the decision of the user. That is known as materiality, that it has the power to affect the decision of the user if they are making a decision based on those figures. That is known as materiality. And for materiality, throughout the process of preparing that financial statements, you need to use judgment. Okay. So these are the steps that you need to do, the 4 steps you need to follow for materiality. First, you have to identify which information is material. Second, you have to assess whether the information is material or not. Third, you have to organize the statement in a draft financial statements, not the final. And fourth, you have to review that financial statement to check the materiality. Okay. Now, when assessing whether information is material or not, what should an entity do? They should consider this thing. Number one, quantitative factor, and number two is qualitative factor. Quantitative factor means you can check the revenue. For example, how big is the revenue, the profit, the asset, or the cash flow. When it comes to qualitative factor, you have to see these things: related party transaction, whether it's a related party transactions or not. Because mostly material items are in the related party transactions. Related party transactions I have covered under IS 24. Unusual transactions. Unusual transaction also usually covers material items only. Geography, in which geography it is, and also wider economic uncertainty. So all these things affects your materiality decision, whether information is material or not. And only when it meets, okay, only when the entity feels, okay, that the effect is material, then only they apply this recognition, measurement, and disclosure criteria. in an IFRS standard. Any IFRS standard you take, for example, IS 16, in order to recognize that asset, non-current asset, they first need to see whether it's material or not. After it is material, then only they will start recognizing it, then they will measure it, then they will disclose it because it's material. If it's not material, then they don't go through the stages: recognition, measurement, and disclosure criteria. Let it be for any IFRS standard. Okay. First comes materiality, then comes recognition, measurement, and disclosure criteria. Now, what is the problem for this issue? The problem is that IS1 says to disclose significant accounting policy. Okay, but this disclosure tends to be, even though they say they tend to disclose significant accounting policies, but the disclosures are usually generic. All the entities, they give general disclosure only. It is not entity specific. And number two, it is simply the duplication of the IFRS standard content. Okay, that's why this information is not useful. It only adds clutter to the financial statements. You understanding? So that's the issue, that's the problem now we are having. And what is the proposal? The proposal is in the exposure draft. And if you see this very recently, just 2 years back in June 2019, 2019 6 means June 2019 only it was released in the exposure draft. Okay, under disclosure of accounting policies. So the board proposed this following things. It is not yet being confirmed. They have just proposed it. That amendments to IS1. What is the amendments to IS1? They are trying to amend IS1 now. They are trying to tell that disclose only material accounting policies, not all accounting policies. Second, guidance is also needed if accounting policy is material or not. Then, so the board proposed that accounting policy is material if it relates to a material transaction. Transaction also has to be material for the accounting policy to be material, and this following things also has to be there. It was changed during the year. Accounting policies changed during the year. If it is changed during the year, it is likely to be material because mostly material accounting policies are only changed so that entities can manipulate the financial statements. That's the reason they changed the accounting policy in the material items only. Number two, IFRS standard offered an accounting policy choice. Wherever there are choices in the standard, IFRS standard, mostly it is material because in the material item only you can play around. Okay. Then, no IFRS standards explicitly applied. If there is no IFRS standard, accounting policy is material in that area. Significant judgment, wherever significant judgment is required, again is material significant policy. And IFRS standard were applied in entity specific ways. Then also it is material. So under this 5 condition, accounting policy is material. Now defined benefit plan. So this is another current issue, which is your IS 19. Small change has been happened under IS 19. Okay. Before, what happened? Before, when there were any changes in the plan, such as plan amendment or curtailment, that means employees are leaving, or settlement, you are settling the employee, what happens? It is not taken into the picture. That change is not taken into the picture because of these changes during the year. Plan amendment, curtailment, or settlement, what happens? Assumption changes, no? Assumptions needs to be updated now, but it is not updated. To determine what? One, the current service cost. What is the current service cost? Service cost means the amount that you have to pay to the employee. What is the current service cost? And the net interest also for the remainder of the reporting period. It is not updated. They are using the same net interest and the current cost based on the previous assumption, which is now updated. So they don't update the assumptions in the previous one. Now they are doing it. So that change has happened. So the change happened in two places: current service cost and net interest. Now they are using it on updated assumptions. This is when the entity remeasures the defined benefit deficit. That means defined benefit liability. Okay. So they have amended this IS 19. Board has amended it. to clarify this. So the entity must determine these two things: current service cost. How? For the remainder of the reporting period after a plan amendment, curtailment, or settlement using actuarial assumptions. Now you have to remeasure your net defined benefit liability. You have to show the impact of this change on assumption because of this plan curtailment, amendment, or settlement. So current service cost will change. Your net interest also will change. Okay, your net interest will be taken on that changed, on that remeasured defined benefit deficit. Okay, and now you have to remeasure that again by applying a discount rate for the net interest. Now let us go to the management commentary. So that's the only change under IS 19. Okay, now management commentary. What is management commentary and what are the elements of management commentary? Purpose of management commentary. Okay, the purpose is what? Through management commentary, you will be able to know the interpret the performance, the position, and the cash flow of an entity. That's the main purpose of management commentary. And second is, you need to know that this is not mandatory. You don't have to mandatorily produce management commentary. But there is a practice statement that has been issued by the board. Okay, where there's a guidance when producing management commentary. So these are some elements of management commentary. Management commentary provides information on these things: nature of the business, management's objectives and strategies, entities' resource risk and objectives or relationships, results of operation and prospects, and key performance measures that are used to evaluate the entity's performance. Can you see from all this, you can understand the financial position, financial performance, and cash flow of an entity. These are the main elements of management commentary. Remember, this is equally important for your SBR exam if you want to pass, because you are going to get question on one of the current issue, either management commentary, either deferred tax, either your debt or equity, anything. You have to be prepared for all the current issue. Okay, and usually each current issues are very small. They are not so much, so you don't have to remember so much, but facts is very important in the current issue. Remembering the right fact: what is the problem, what is the proposal going on. Now we are coming to the sustainability. Okay, nowadays everyone makes report on economic, social, or environmental effect on the organization. Social report, environmental report, it is known as a sustainability report. So these are some reporting initiatives. Okay, over the years there are a number of sustainable reporting, such as United Nations Global Reporting Initiative and International Integrated Reporting Framework. You don't have to know the detail of all these three types of reporting initiative. You just have to know that there are these three types. Okay, that's why, because there are different types, it's hard to compare sustainability reports. So this is a problem. This is an issue. Okay. Now we are moving on to the another current issue, which is debt and equity. So in accordance with IS 32, okay, how do you present financial liability when they have a contractual obligation to pay cash or another financial asset? It is known as a financial liability or debt. It's the same thing. Or transfer financial instrument on unfavorable terms, or deliver a variable number of entities' own share. If these three conditions are there, it's a financial liability. That means it's a debt. That's why it's very important that you have to be able to distinguish financial liabilities from equity. Most of the questions, if you see, this area is also very frequently asked, whether a share has to be presented as a debt or a equity. I have recently done a question on that from revision kit. The number I forgot, but make sure that you go through that question if you come across a question like this. Why? Why you have to differentiate between the liabilities and equity? Because sometimes liabilities you might present as an equity you might present as a financial liability. That's why it's important. Because equities are more riskier, liabilities are more riskier than equity. Why? Because you mandatorily have to pay the interest under liabilities, not for the equity. That's why it's more risky. And number two, if your liability carrying amount changes, it will affect your profit and loss. So these are the two reasons why you have to distinguish between financial liabilities and equity. Now, applying IS 32 is problematic if you go by their rule in differentiating debt and equity. They're having contractual cash flow to pay cash, contractual cash flow to financial asset. So what did the board do? In the discussion paper, they proposed this. The board proposed that financial instrument should be classified as what? Financial liability. If it exhibits one of the following characteristics, this was not there in IS 32. If you go by IS 32, it becomes more tough. Having contractual right to pay cash, to pay financial asset. It's hard, right? That's why discussion paper says it has to be classified as a financial liability if these characteristics are there. Number one, unavoidable contractual obligation to transfer cash. That means you cannot avoid it. You have this obligation and you cannot avoid it. You have to transfer cash or another financial asset at some time, but not liquidation time. Okay, not in the case of liquidation. Then it's not taken as a financial liability. Okay, under the terms of liquidation, or an unavoidable contractual obligation for an amount independent of the entity's available economic resource. That means you cannot avoid it. You have an obligation to pay. You cannot avoid it, but that obligation is not dependent on the available economic resources that entity has. It's independent. You can say right to it. It is issued by DP. DP means discussion paper, and 2018 Jan 2018 1, right? So you can see this characteristics were not there in IS 32. These are different under discussion paper. So based on this, it's now easier for you to know whether it's a financial liability or not. If these two things are not there, then it's an equity. Okay. Now moving on to the deferred tax, the last current issue. So under deferred tax, what is the problem? Under every issue, you need to know the problem and what is the proposal that is put forward. So the problem is that this prohibits the recognition of deferred tax if temporary differences is that does not arise from a business combination. Okay, that arises from a transaction that is not a business combination, you cannot recognize deferred tax. And the second one is it does not affect the accounting profit nor taxable profit at the time of transaction, then also you cannot recognize deferred tax. Okay, so it's a problem. So because of this recognition exemption, that means you cannot recognize deferred tax asset, it is exempted in these two conditions. What does it mean? Deferred tax cannot be recognized by lessee, okay, in jurisdictions where tax reliefs can be received in respect of the lease liability. Okay, wherever you're going to get tax relief because of lease liability, now you cannot receive it. Why? Because deferred tax you cannot recognize, it is exempted. So the proposal that is put forward is in the exposure draft. Okay, the board proposed to amend this, change this deferred tax recognition exemption. Okay, so this is relating to what? Deferred tax relating to assets and liabilities arising from a single transaction. From a single transaction, deferred tax is also there as related to both assets and liabilities. Then if a transaction is not a business combination, also, and it does not affect your accounting or taxable profit also, what did they say? Do not recognize deferred tax. But what is the proposal saying? But equal amount of deductible and taxable differences are created. That means deductible is also same, taxable differences are also same. Then what happens? Then the board proposes that you need to do number one, deferred tax asset is recognized. Okay, you recognize deferred tax asset in relation to what? Deductible temporary difference. To the extent that future profits will be available against which differences can be utilized. That means in the future, there's a probability that profit will arise, again which you can utilize the difference. And second, deferred tax liability also you are going to recognize it. On what? Taxable temporary difference. But it must not exceed the amount of deferred tax asset recognized above. Your deferred tax liability cannot exceed your deferred tax asset that you have just recognized it. If it is from the single transaction where you're having assets also, liabilities also. Okay, so this is the proposal put forward by the exposure draft, and make sure that you go through this current issue and do a question on current issue. Just reading current issue and keeping it is not easy. It will not be helpful. You need to do questions and actually write and see the types of question that can come under current issue. So that's it. I have finished. Okay, and that's the end of your SBR revision series. Now, what you need to do is do past papers. Make sure that you go through the question to check the pattern. Okay, and since this is the last week, I think just 3 or 4 days are left. Okay, so don't stress yourself, don't panic, and best of luck. And thanks for watching all the videos on my revision series, and do comment me and let me know if it's helpful for you. So inshallah in the future I'll be making more of this videos, maybe for my other papers also. And thanks a lot because I have got many positive comments on this SBR revision series. I've never thought that I will be able to do it before the SBR September exam, but thankfully I managed to cover all the important areas are covered for your SBR, starting from all the IFRS and IS standard, current issue, then analysis and interpretations, right? The questions are covered. So if I forgot anything that I didn't mention, or if you want me on some specific area, small areas, not in depth, do let me know before the exam so that I can quickly go through it and make it, but not the lengthy ones. And best of luck.